Hey folks, Chris Temple back with you again. And we've got another guest today as we get geared up just over a week away as we're recording this for Strategic Investment Insights Conference, the 6th and 7th of May at the Lincolnshire Marriott, just hop and a skip from either downtown Chicago or O'Hare Airport. So if you've not registered already, make sure you do it in the remaining week or so as we're recording this. Even if you can't make it in person, make sure you register because that'll give you access to all of the companies that we have at the show, our panel discussions, two very, very important subject themes that we're going to have on these panels, given the drastic changes that we're seeing in the world, 40 plus year inflation. It's not going to go away anytime soon. The unraveling of globalization that we've never lived in any other regimen globally than globalization, and that's starting to come apart. We're going to have currency wars, commodity wars, you name it, and a lot of things where our lives are going to be upended. So with that macro backdrop, we're always looking for opportunities for people to invest in, and one of the more intriguing ones in the precious metal space right here in the good old US of A is Integra Resources. And now I'm joined here by Josh Surface. He is the executive vice president for the company, and he's going to be with us in not too many days hence in Chicago. Great to have you, Josh.
Yeah, thanks, Chris. Really looking forward to coming to Chicago and speaking at the event.
You were on the team several years ago with George Salamis, the head cheese at Integra, with the old Integra Gold, and you built a great asset from almost pretty much scratch in Eastern Canada, sold it to Eldorado about 5 years ago for $600 million. Not a bad piece of change and not bad work. And then you found this asset in the state of Idaho, which of course is one of the better jurisdictions among states in the US. You even got former Governor Butch Otter, who is one of your directors, and a lot of help in that state. But tell us, Josh, about this asset. Give us a quick overview. Of course, there'll be more in store for the folks at the conference when you get into greater details, but tell us how and why, the Delamar project, what made you glom onto that?
Yeah, Chris, thanks. And you're right. After we had sold the previous project in 2017 to Eldorado, we decided we wanted to keep the band back together. The management got pink slipped, but we felt like we had a pretty good blueprint for advancing these types of assets. And so essentially what we were looking for was something similar. We wanted a past producer. Delamar produced from the 1970s until the 2000s. We wanted something with a lot of exploration upside, and we wanted something which you rightfully pointed out in a jurisdiction where we knew we could push it into permitting and get it back up and running again. And so we found that in Delamar. Idaho has been a fantastic place to work. It's ranked very high by the Fraser Institute on mining investment and perception of mining within the state. And then, as you rightly pointed out, adding Butch to the board has been huge. Former 3-term governor, just really helping us navigate as we push this towards permitting in the very, very near future.
That's neat. Now, when you first acquired Delamar, you knew it was a past producer. It had one significant open pit.
Two
significant open pits. And you figured there was going to be some room to expand those and that, but the more you worked there, the more you quickly found out that maybe this had even more exploration upside than you bargained for. Because I know I've been following you guys now for 4 or 5 years. I guess it's been almost, for quite a while. And a lot of the news you've put out, some of the stuff that you never contemplated at all. Yeah. When you first got this property, you've had some great drilling success. So give us an overview of that.
Yeah, so we've really been able to add resource quick here, which was another thing we wanted. Is Kinross had actually shut it down, not because they ran out of gold and silver, but it was really driven by gold and silver price. So they, at $300 gold, at $5 silver, they just weren't making the margins, and so they shut it down. And when we acquired the project, there was no resource. In 2017, we put out a 2.8 million ounce all categories resource. That grew to 4.4 in 2019, and now we're just under 5 million ounces all categories on the project. And so essentially we've been finding gold at about a $12 discovery cost, which is great. So it's $12 to find a new ounce. And that's just the stuff that really was near what Kinross mined. We've since added a bunch of different targets: Florida Mountain Deep, War Eagle, Black Sheep. all of these things are not in a resource, but they have a lot of potential to add resource quickly. And I think what you also were referring to, Chris, is that we also have these low grade stockpiles. So since Kinross was going after the higher grade material, they left low grade stockpiles, about 60 million tons of material with all gold and silver grades that are far above our cutoff. And so that for us is a real no brainer on adding quick ounces to the heap leach aspect of this project and moving it forward. And we're going to start doing that this summer, which we're really looking forward to.
Now, you guys had previously said, and the slide is one that you're going to have, I trust, at the conference. So I don't want to give people a dated one on here.
Yeah.
But you guys stack up in comparison to a lot of other potential mid-tier level producers real well on cost and so forth. I mean, you're one of 5 or 6 on this continent, I think, that have got the kind of resources with the potential low costs and so forth. You put out a PFS recently. Tell us about how the numbers changed in that PFS as far as what your initial production profile could be and that kind of thing.
Yeah, so that PFS we put out a few weeks ago, it looked at a much larger mining scenario. So about 163,000 ounces over a 16-year mine life. That 163 is sort of the first 8 years. What we're really focused on now, just given the permitting environment, is going forward with a heap leach scenario and then later expanding to the mill. And when you look at us as a heap leach comp, first, there's just not a lot of companies out there that are going into the permitting stage. And when you look at us against those, our resource is larger, our all-in sustaining cost, so how much money it takes us to get the ounces out of the ground, is very much in line with our peers. And so, this is a very economic project in a really great part of the world that we can bring forward and then add all of these bells and whistles that come along with the expansion profile. And from an M&A perspective, if you think mining companies are looking for ounces in safe jurisdictions, there's just not a lot of projects out there in North America that would meet kind of the de-risked level of permitting where we're at now. And so we think, this is a great go it alone project where we can continue to push this forward. But there's also that M&A angle, which is that, if companies are looking for safe ounces, there's not a lot of projects to choose from. And when you look at the total resource we have on site, it's a very compelling case.
Now, that total resource you alluded to a few minutes ago, Josh, is around just under 5 million ounces, this last estimate. But you're continuing to do some drilling.
We are. Yeah, we're drilling now.
And right. And so what is there a target where you might be updating it yet again, that resource estimate?
Yeah, I think you'll probably see us update it in the new year. So beginning of 2023.
After this whole year is done and you've got everything accounted for and whatnot. Okay.
Yeah.
Now, in the recent past, and I know what I told my members at the National Investor. You're one of my recommendations. Like a lot of exploration companies, small and mid-size, the share price has been a little gruesome recently. We all know, even though gold has done well. You haven't been alone in that. But give us your perception of why the market didn't react as well when you put out that PFS, and why. I mean, my opinion is it makes you a bigger bargain. But why do you think that was, and how do you think, from your perspective, that the market was wrong?
Yeah, I mean, I think really it boils down to is capital. Given the inflationary environment, and as you pointed out, we're at 40-year highs with really no end in sight. People are hesitant to see any capital. People don't want to see you build projects, right now, just given how much things cost. And we saw that in our PFS. We saw earthworks was a 67% increase. Cement and consumables were 30%. And so we costed this thing out at very high inflation numbers, or very high, inputs. And so I think people just were weary of capital, which is fair. But now you're starting to see these other mining companies talk, especially those that are building, are talking about cost overruns. They need to, finance because their CapEx has changed from a report they did 2 years ago. And so I think that's where we saw a lot of pressures. People just don't want to see those numbers. Now, where I think what's really interesting about our report is that if you think, we're at a very peak inflationary environment, who knows how long that lasts, but we've costed our project out at the highest. So 3 or 4 years from now, we build this, if things have more normalized now, a lot of our costs are going to be lower. And so that's a benefit. And I think as more studies come out, our study will continue to look better and better as you start to see some of the pressures that other companies are putting out there. So I think that was really the big, the big misconception and sort of the bit of the sell-off and the pressure that we saw.
But let's be straight. I mean, even with the higher costs, and everybody's reported them, as you said, I see it all. I see it constantly in companies that I follow. It doesn't mean it's not an economic project. That maybe it's less so. And from my perspective, I think, correct me if I'm wrong, I think what some investors did is they thought, well, gee, this is going to be obscenely profitable. So now it's only respectably profitable. And gee, we liked obscenely profitable better.
Yeah. Oh yeah.
And you guys weren't using the $2,000 for gold.
Nope. No. And that's the thing is even, today's gold price, called 1900, it's $1,000 an ounce profit. It costs us less than $1,000 to get it out of the ground. So it's profitable. It's very good margins.
People are fickle. And again, there's just not that many stories like yours where you got roughly 5 million ounces and still with room to grow. That puts you on a short list of assets like that, especially in a good jurisdiction. So I'm sure not losing any sleep. I've been telling people to buy more, and I think the people at the show are going to learn why they should be getting involved too. So Josh, thank you very, very much for taking a few minutes today. We'll let all of the folks know you're going to be there, and I'm looking forward to seeing you in just over a week's time.
Yeah, thanks. Can't wait. We'll see everyone next week.